What if I told you that a balance sheet is like a company's financial selfie, but instead of showing how good they look, it shows exactly what they own and what they owe? In the next 5 minutes, you'll understand balance sheets better than 90% of people. Hi everyone, welcome back to Accounting Analogy. I'm here to break down financial concepts in the simplest way possible. Today we're tackling the balance sheet, one of the most important financial documents you need to understand whether you're investing, running a business, or just want to be financially literate. So, what exactly is a balance sheet? Think of it as a snapshot of a company's financial health at one specific point in time. It's like looking at your bank account, but for an entire company. The balance sheet has three main parts, and here's the magic equation that makes it work. Assets equals liabilities plus equity. Or in simple terms, what you own equals what you owe plus what's actually yours. Let me break this down with a personal example. Imagine you buy a house worth 30 lakh rupees. You put down 6 lakh of your own money and take a 24 lakh rupee home loan. Your asset is the house worth 30 lakhs. Your liability is the 24 lakh home loan. And your equity, what you actually own, is 6 lakhs. See how it balances? 30 equals 24 plus 6. Now let's dive into each section using a real company example. Tata Power, one of India's largest power companies. First, assets. These are things the company owns that have value. Current assets include cash, bank deposits, money owed by electricity consumers, and inventory of coal and fuel. Non-current assets are the big-ticket items: power plants, transmission lines, solar and wind farms, and investments in subsidiary companies. Second, liabilities. These are debts and obligations. Current liabilities include employee wages, bills to vendors, and short-term borrowings. Long-term liabilities are loans for building power plants, bonds issued to raise funds, and pension obligations. Third, shareholders' equity. This is what belongs to the shareholders after all debts are paid, essentially the company's net worth. Here's Tata Power's actual balance sheet snapshot. Total assets of 52,645 crore rupees, with shareholders' equity of 18,366 crore rupees. This gives you a real sense of the scale we're talking about. Why should you care about balance sheets? Three big reasons. If you're investing, the balance sheet helps you spot red flags or cash hoards. A power company with way more debt than assets, dangerous. Strong cash reserves, better positioned for market volatility and renewable energy investments. If you're job hunting, check your potential employer's balance sheet. A company drowning in debt might not be stable for long-term employment. If you're running a business, your balance sheet is your financial report card that banks and investors scrutinize before making decisions. Here are three mistakes people make with balance sheets. First, thinking more assets always means better. Not true. If those assets are funded by massive debt, that's dangerous. Second, ignoring the dates. Balance sheets show one moment in time. Tata Power's balance sheet on March 31st might look very different from April 15th. Third, not comparing. One balance sheet tells you nothing. You need to compare it to previous years and to competitors like Adani Power or NTPC. So remember, assets equals liabilities plus equity. That's your foundation for understanding any company's financial health. In our next video, we'll dive into the income statement. That's where you'll see if a company is actually making money. If this helped you understand balance sheets, hit that like button and subscribe for more finance basics explained simply. Drop a comment with what financial topic you want me to cover next. Thanks for watching, and I'll see you in the next video.